So I guess we've got to look at just firstly what is a hedge fund, and then why do people think they're evil, and then finally I'll tell you why we're not. In fact, actually why we might be considered a force for good. Now, there's a lot of misnomers, mistakes really around the place as to what a hedge fund is. Now, to be fair, the concept of a hedge fund is extraordinarily broad. In funds management, there's what we call conventional long-only management. That is the sorts of things that exist in most people's super funds, where fund managers just buy shares and hope they can beat the market by a little bit each year. And that's how those managers are rewarded. And by the way, those managers get rewarded even if they lose your money, because all they have to do is not lose as much as the market in a bad year, and they say, relatively speaking, that's a good performance. And there's all sorts of economist jokes and things about, you know, relative performance and whatever. But the thing is that hedge funds are a different class of entity. A hedge fund uses all sorts of different techniques, but one of the common characteristics of all funds is that they must make money for their investors. The hedge fund manager only gets rewarded if the investor gets rewarded. So that's point one that distinguishes a hedge fund from a conventional investment fund. Secondly is the techniques that hedge funds use to achieve this end. Now, as I said, conventional fund managers buy real estate, shares, bonds, whatever, hope they increase in price and reward themselves as a result. Hedge funds do all sorts of different things. They use tools like leverage. They borrow money to enhance their returns. They use derivatives, options, futures and so forth to hedge risk. In fact, the original hedge funds in the 1950s in New York were fund managers who figured that they could pick stocks better on average than the market, but they wanted to eliminate the market risk. So they bought the shares that they liked, and they hedged, that is, they sold the entire market. And if their portfolio outperformed the market, they made a gain. So they were trying to hedge or eliminate the market risk, what we call in the industry the beta in their portfolio. So a classic hedge fund, and the one I run is like that, uses derivatives, options, futures and so forth to hedge against other events, to hedge the things that we don't know particularly well. Now, hedge funds do lots of other things. I mean, they speculate on commodities, for example. They speculate on currencies. They speculate on interest rate movements. They speculate on all sorts of things. Probably the biggest difficulty that people have with trying to come to grips with what a hedge fund does is that hedge funds short sell. Now, there's a great film with John Cusack and Minnie Driver called Grosse Point Blank, and they're the class of 1986, I think it is having their 20-year reunion. And it turns out that John Cusack is now a professional hitman. And when his former girlfriend, Minnie Driver, asked him about this, she said, "How did you get into that?" He said, "Well, they did some testing at the CIA and they found that I had a certain level of moral flexibility." Short selling is a bit the same. Most of us can understand that we buy something and we hope it goes up and then we sell it for a profit. But we do find it more difficult to say, okay, how can I sell something I don't own because I think it's going to go down in price? And that's what short selling is. Now, the mechanism is confusing enough for people who don't do it, let alone the potential impacts on markets. Now, the way short selling works is that someone like me, a hedge fund manager, goes to a lender of shares. Now, the lender of shares is just a custodian, typically in Australia, of superannuation funds, and says, I think share XYZ is going to go down in price. May I rent it, borrow it and rent it from you? And by the way, you pay a fee for doing that. And they say, sure, we've got X number of shares. Our client is unlikely to want to sell them. We will lend you this amount. This is the price. And then we sell them, all right? And because you have to deliver any selling you do, you have to deliver the shares within 3 days, you must have the borrow in place before you can do the sale. Implicit in that contract is that at some stage of the future, you will have to give those shares back. And the only way to give them back is to buy them back on the market. So for every short sale at one level, there is not just the possibility, there is an absolute buy of the same number of shares, the same quantity at another level. Now, if the hedge fund manager is right and the market falls between the sell and the buy, you've made some money. But remember, most of the time markets rise, they don't fall. So this idea that short selling, you can just drive share prices down at will is ridiculous. Short selling is very, very, very hard because the amount of money you can lose is infinite. So on a short sale, you can only, the maximum a stock can fall to is from wherever you short sell it down to zero. But the maximum it can rise, well, that's potentially infinite. So the potential for losses with short selling are actually significantly greater than if you buy shares. Now, this is something that's overlooked by a lot of people. And the other thing about short selling is that not that many hedge funds do it in isolation. Typically what you're doing is you're saying, look, take the 4 banks in Australia. I think, relatively speaking, Commonwealth, and let's pick one out, Westpac, are doing a better job than NAB and the ANZ. So what I might do is buy Commonwealth and Westpac, but short sell NAB and the ANZ, because I just think that I've picked the two that are better off compared to the other two. So most short sales, there's a short in one part of the market, but it's offset by a buy in another part of the market. And that's what you call being hedged. And the Australian market is actually quite a good market to do that because it has a lot of duopolies. You've got BHP and Rio and mining, you've got the two airlines. You, until recently, had two separate breweries, although one of them's been taken over. You've only got 4 banks. You've only got a couple of large wealth managers and so on. So our market, indeed our economy, is dominated by 2, 3, 4 companies in an industry. And that throws up opportunities when one or two of them, when the value gets out of whack. And what you're trying to do in a hedge fund is say, well, they're going to revert to their means, that this discrepancy in their relative value should come back. And that's why you use short selling. So let's go through having defined what a hedge fund is and how short selling works. And I will take questions in about 10 minutes' time. What are some of the reasons or some of the myths out there that people have about hedge funds? And you're quite welcome to think that I'm just being self-serving here, but remember, I'm not doing this for the good of my health and so forth. But hedge funds normally have no need to try and publicly justify themselves. They're just there to make money. That's it. And so is every fund manager. They're just doing it a slightly different way. Now, Michael, in his introduction, mentioned the global financial crisis. Well, there are all sorts of causes to it, but it's now well documented that the main ones was it was a runaway US housing market and a pile of debt that got built up with it. So there were bad lending practices by banks, bad borrowing by consumers. I mean, there's no lending without borrowing, so just to blame the banks is ridiculous. And there were some hedge funds that profited in a massive way. I wrote an article in The Age today, and Michael Lewis, who wrote an excellent book in the 80s called Liar's Poker, and I recommend it to you, has written a new book called The Big Short. And he's referring to a number of managers that decided that the US housing market was overvalued and worked out a way to profit from its inevitable collapse. One of them I met a few years ago called John Paulson. And the hardest thing for them was to try and work out a way you can't short sell houses very easily because you'd have to go and borrow the houses from the people that own them, and typically they don't want to do that. What they did was they found that the banks, the interest rate margins they were charging to good customers were virtually no different to the margins they were charging to bad customers. And they said, righto, and in America, which is not something we have here, that was the so-called subprime market. You can buy and sell those interest rate spreads. And they said that's ridiculous. A good customer should have an interest rate which is substantially lower than a bad customer. So they essentially bet that the interest rate differential between the two pools of borrowers would widen, and widen it did. It went from about 25 basis points, 0.25%. That is, the people who had the so-called ninjas, no income, no jobs, no assets, could borrow at the same price as the people who had plenty of capital behind them. Clearly that was ridiculous. So some hedge funds profited from the global financial crisis, but I've got to tell you, most hedge funds didn't, because the weight of money between 2004 and early 2008 or late 2007 was that the housing market was going up and everybody wanted to try and profit from that. In fact, one of Australia's most prominent hedge funds, Basis Capital, did just that. He bet on the US housing market going up. And in fact, John Paulson, another hedge fund manager, bet against Basis via the intermediary of Goldman Sachs to bet that it would go down. One hedge fund lost a lot of money, another hedge fund made a lot of money. Now, it's a zero-sum game, but I mean, it's not damaging to society if they want to bet against each other. So hedge funds didn't cause the GFC. Some profited from it, but I can tell you a lot more lost money from it, just like everybody else did. Going back to short selling, does it make share prices crash? Well, it was interesting in Australia. In September 2008, I had one of my worst weekends ever. I had the flu very badly, and B, I spoke to the Belinda Gibson, who was one of the top people at ASIC on Friday afternoon, and I knew that ASIC was deciding about what to do with short selling. And she assured me that, this is off the record by the way, but that there were going to be some regulations about disclosure and whatever, but that was all. Sunday afternoon I get a call from a journalist at The Australian saying short selling's been banned, full stop. I mean, and that makes my job very difficult, because if you can't short sell, you're not really a hedge fund. And ASIC, and I know there's a couple of people from ASIC in the audience, had not thought it through. For example, the whole derivatives market, the options and futures market, depend upon short selling. They cannot function without it. And there were people running around that first week that it was banned saying, well, what are we supposed to do? And no one had any answers. But anyway, short selling was banned in September 2008. It was re-allowed in waves later on in 2009, and financial stocks only by May 2009. Now what's interesting is the market continued to fall in Australia even after short selling was banned. And in fact, it only started to recover when short selling was allowed again. So the theory, if you like, that short selling caused the share prices to crash is not borne out by the evidence. When short selling was banned, shares fell another 20%. When it was allowed to occur again, the market started rising. Now, I'm not saying that they necessarily caused, but you would have to have a very strange way of looking at things to say that therefore short selling caused share prices to crash. Short sellers go to where volatility is. They go to where they think prices are going down, but they don't cause them to go down because remember, every short sale must be bought back at some stage. The reason the markets were falling is because the owners of things were all trying to exit through the door, as you'll probably be doing in about 20 minutes' time at the same time. Allied with that is a view out there that hedge funds manipulate the market. Even though some hedge funds have billions of dollars at their disposal, compared to what pension and superannuation funds have, they are tiny. The idea that the relative mouse could manipulate the relative elephant, even children's tales to the contrary, in financial terms is simply not true. Market manipulation in any case is illegal, and to the extent that it does happen, and it does happen, I can tell you, it's illegal, but it's not hedge funds, generally speaking, that are doing it, simply because they don't have sufficient assets to do it. I mean, the massive weight of money is against them. So, again, if hedge funds could just push the market down at will, why has the market gone up in the last 18 months? Why didn't we, the hedge fund community, just keep it down for our own nefarious ends? Answer is, because we couldn't. Some people think there was a moral problem with hedge funds, some hedge funds making money when others were losing it. The Archbishop of Canterbury in the UK said as much and wrote articles about it until it was pointed out that the Anglican Church's own investment funds tended to short other currencies to hedge against the pound, and he went rather quiet on the subject after that. Look, if you can make money when everybody, Rudyard Kipling style, if you can make money when everybody else around you is losing it, I'd say that's not immoral, that's smart. It's difficult to do. I've worked through a lot of crashes. One of the reasons I started a hedge fund was because as a 19-year-old I was on the trading floor when we had a physical trading floor here in Melbourne during the 87 crash. And I saw people in the aftermath lose their jobs, lose their livelihoods, lose their houses, and I thought I don't ever want to be in that situation. And I've seen many crashes occur since then. So, to be honest, if I knew when crashes were going to occur, I'd be living on my own island. But the point is, there is nothing wrong with making money because you are doing things differently from the pack. And in fact, if you want to make a lot of money in whatever sphere of existence you like, you have to do things differently. Running with everybody else is not going to make you spectacularly rich, unless, of course, you just buy a house at the right time here in Melbourne when everybody else did. There are issues about government bailouts of hedge funds. Governments did not bail out hedge funds. They bailed out investment banks and banks. They bailed out the source of the capital that had been badly allocated, badly lent before the global financial crisis. They didn't bail out individual hedge funds. In 1998, there was a bailout of a hedge fund. It was called Long-Term Capital Management. It had no less than 2 or 3 Nobel Prize winners on its board, which didn't stop it from losing a lot of money, which again shows the often wide divide between academic ability and genuine financial ability. But generally speaking, hedge funds either went out of business or stayed in business because they picked things correctly. There's a view out there that hedge funds spread false rumours about things. Look, I can tell you, the whole market is one big rumour. No one knows what is going to happen the next day. Now, if you knowingly spread a false rumour, and again it happens, that is illegal. And I'm not saying there aren't some hedge funds that don't do it, but I can tell you most false rumour spreading occurs on the buy side. It's stockbrokers spruiking things and saying XYZ is going to go up, get on board now. Again, for any representatives of ASIC here, just all you have to do is get hold of all the emails the stockbrokers send at the end of trading every day and at the start of trading the next morning. You put all those people in a room, I can tell you, you'll have plenty of rumour mongers there to occupy yourselves with. The final criticism of hedge funds, and this speech I've given today is sort of editorialised in summary form in both the Age and the Sydney Morning Herald this morning, and I've already seen some of the comments, and as usual, it's how do you sleep sleep at night? You're evil, this sort of thing. But the criticism that I get, and people at dinner parties and things say it, is that hedge funds are greedy. And to which I respond, Yes, so what? I mean, you go to work for nothing each day, do you? Do you work for the good of your heart? No, you don't. You know, everybody involved in the financial industry is greedy to some extent. That is, they want to make money. I mean, you don't go in the industry unless that's what you want to do. Now, there's different ways of making money. Some people have different views about whether it's socially valuable. I mean, I can tell you the stock market, even though it was set up to raise money for companies, 99% of trade is secondary trade. That is, it's just people speculating on shares. It's not people, you know, nobly raising money for new and exciting businesses to help drive the wealth of mankind forward. It's simply people speculating. Now, as I point out in my article, you might as well say, well, that's not socially very useful, and I'm not going to go on about how it gives market liquidity and market depth and all these sort of rather vague things that are to the good. But if you want to sit there and start criticising someone for saying what you do isn't socially useful, well, hey, have a look around at our society. You know, 90% of what we do ceased being socially useful, ceased to be about human existence, you know, like food, shelter, clothing a long time ago. We're a society that's built on entertainment, about filling up the day, trying to keep ourselves amused. You know, we have people that try and sell us things. We have TV shows that, you know, we're supposed to watch, appalling radio talkback hosts to which we feel compelled to listen, and I'm one of them. You know, sure, a lot of what hedge funds do isn't all that socially useful, but hey, neither is a whole lot else that goes on in the markets. Hedge funds at their best keep the markets honest. They keep companies honest, and they make good returns in bad times for their investors. And as a result, I don't think they're worthy of all the criticism that they attract. Thank you very much.